Welcome back. And now the most awaited discussion of the day, a chat with somebody who's seen almost 30 years of cycles, business cycles, economic cycles and market cycles in emerging market, which an overall in the global market setup is considered a very volatile and difficult terrain. And Mark Mobius of Mobius Capital is joining us today. He's been investing in this difficult terrain for over 30 years, and that's the reason why he's called the Dean of Emerging Markets. First of all, Mark, thank you very much for joining us today on ET Now and for being such a valuable contributor on our journey for 13 years as we celebrate our 13th anniversary today. Mark, let me start by getting a bit of your rich experience. Thank you so much. We, miss meeting you in person next time, perhaps, whenever you're visiting Mumbai. So, Mark, let's start by understanding your thought on the nature of risk for emerging markets like India. You've been investing in emerging markets when India did not even open up to FIIs, and India was a baby frontier market. How is India placed right now versus emerging markets to face this risky environment?
Well, India is in a very, very good spot now because the Indian macro environment is very favorable from a long-term perspective. I would characterize India as being in its takeoff stage, so to speak, because we're now at a stage where incomes are rising. Of course, economic growth is very, very good. And the impact of technology is having a very, very important impact on the Indian economy and the Indian population in general. So I would say India is in a very sweet spot, let's put it that way.
Right. How prolonged do you see this issue of risk aversion, the global risk off which we are seeing? Because some say that global central banks' hands are quite tied because the nature of the risk is such that beyond a point, hiking rates will actually not be able to control inflation unless you adopt a sledgehammer approach and completely stall growth, which again is a big issue. How do you see this being balanced?
Yeah. Well, the central banks around the world, starting with the Fed, tend to take a heavy-handed approach because they have a model which tells them, look, if you want to control inflation, you've got to raise interest rates. And you've got to raise interest rates higher than the measure of inflation that you're using. Of course, the measure of inflation, as I pointed out in my book, the inflation myth is another big question mark. But anyway, let's assume that the inflation rate is correct in America, and that's saying 8.5+%. Okay, that means the real rate has to be positive, and that means that the central bank, the Fed, will have to raise rates above 8.5%. That's 9.5, or whatever, unless the inflation rate comes down. Of course, that's a big question mark. So I would say we are looking at higher and higher rates. And I'm frankly surprised that people are shocked by the 0.75% rise that the Fed just instituted. It's not surprising to me at all. They're headed for 9%. So we've got to get ready for that. However, now this is the most important point. High interest rates do not kill markets. Stock markets can go up in the face of high interest rates. We must remember that. Temporarily, there'll be some impact, but in the long run, if you look at the history of bull markets around the world, bull markets often are accompanied by high interest rates and rising interest rates, I might add.
Right. Mark, there's also one point which some of the strategists are highlighting, that global growth has been cut lower, the estimates by most agencies, but the global profitability estimates going forward have still not been cut in the same proportion, which means that there is scope for cutting the earning estimates of companies downwards more than just about economic growth cut. And if it doesn't happen in time, even after this sharp fall, global markets will continue to appear expensive. Is it a justified kind of a hypothesis?
Not really. The reason why you have to look at this carefully and make differentiation between various kinds of companies. You're going to see winners and losers. In any kind of situation like we have now, you're going to have winners and losers. The winners will be those companies that have a high return on capital, have low or no debt, and have earnings growth. Now, how do they get earnings growth? They get earnings growth as a result of pricing power. So in an environment like this, high debt companies that have a problem with debt will go under, and their market will be taken over by the leaders. And these leaders then will have pricing power. So they'll be able to raise prices in line with or even higher than inflation. So that's one of the explanations, by the way, why markets go up even in the face of high interest rates, because the index that's made up of large companies that have pricing power tend to go up in these times.
That's an important point that you made. Now tell us, because it is not possible to really manage money for such a long time without really having a very close watch on geopolitics. This entire issue between Russia and Ukraine seemed to have lasted way longer than anybody had thought so far. It may have gone into the fringes of the country, but at least it is still persisting. And there's another Cold War kind of a situation between US, Europe on one side, and China, Russia. Where do you see all this actually heading? Because this also is just not helping put to rest some of the big issues which the world is facing on the economic front.
Oh, there's no question. There's a big risk, and of course, the nuclear war is a risk that is with us all the time because so many countries now have nuclear weapons and mistakes can be made. So this is something we have to look at very, very carefully. However, if you look at the history of wars, in fact, recently I did a little study looking at the Korean War, the Vietnam War, World War II. All during this time of these wars, the market, the S&P 500 was going up, not down. So a war does not necessarily mean that the markets will go down. The markets actually could go up in the face of this kind of situation. And the reason, of course, is that governments start spending on defense and on other things, and companies grow in the face of this spending. So you have a bullish market. So it's really interesting when you look at that phenomenon. War does not necessarily mean a bear market. It means actually a bull market.
Mark, what about the US markets? They're down, 33% on NASDAQ from top, almost bear market territory for S&P and Dow as well, 20% plus. After a 10-year-long one-sided bull run, do you see sufficient correction which have happened there, or do you see scope for further valuation compression in US?
We probably have more to go. If you look at NASDAQ, for example, it's down more than 30%. And of course, you have to pay attention to the cryptocurrencies. Many of us don't realize how many people around the world are looking and invested in, I use the word invested very carefully, in the cryptocurrencies. And when cryptocurrencies go down, a lot of people feel poor. And you can see Bitcoin as a leading cryptocurrency has gone down dramatically. It's far down further than the S&P or any other index. And it's kind of a leading indicator. And given that, I believe that the other indices, the S&P, NASDAQ could have more to go down. But then we'll have a bottoming effect and the next bull market will begin. So great opportunity to buy bargains, but you have to, as I said, you have to be careful to make sure you have companies with a high return on capital, pricing power, and earnings growth potential, and no debt.
Yeah, that's interesting that you brought up cryptos. We remember having this chat with you at the time when not having crypto, make all the investors, feel as if they are missing out on the next big thing and the next Tesla and the next Microsoft. But look at how massive value destruction crypto universe has seen. For all you know, it may go back, but it does give a sinking feeling to a lot of participants across the world. 80-90% damage in many of the tokens from top, and almost 20% variation on a daily basis. Doesn't make for a very fragile kind of asset class. But what do you see of the future of this asset class, if I may call it, from here on, after such a big kind of deflation has already happened there?
Well, I think by the looks of it, and again, nobody can predict markets, and I'm not the first to try to predict any market, but I would say, in looking at it, my opinion, cryptos have more to go down because when people begin to lose faith, which is, let's face it, it's, I always like to tell people I don't want to talk about cryptocurrencies because I don't like to talk about religion, because it's kind of a religion. It's a faith. And when people begin to lose faith, then there's nothing left. There are no dividends. There's no interest being paid. There are no assets there except something on the internet. And when people lose faith, then it can go down much, much lower and can go to zero, really, at the end of the day. So we have to watch the space very carefully because there are millions, if not billions of people who have bought cryptocurrencies. And that's the only thing they've bought. They haven't bought anything else. They haven't bought stocks. They haven't bought bonds. They believe that this is the next great thing since sliced bread. And they're going to be out and they're going to be very unhappy.
Right. Mark, I would also like to get your opinion on a subject which may have a role to play in a country's economy and, of course, subsequently in the stock market, and that is political leadership. It may not have a big role in the short term, but when you look at decades, it does have a big role on the policies taken. Now that this leadership is also completing 8 years in office and is making plans which are even 25 years ahead, all of that, how do you see that role of a stable government, the kind of stability the country is seeing? And because India's role also in global order is undergoing a very slow and silent change.
Very, very important. And India is probably a very good example with the current leadership you have. It's a forward-looking leadership. It's an incredible way that the current leadership in India has adopted technology and spread technology to every corner of the country. It's an incredible development, and it's quite mind-boggling when you think of it. They've done an incredible job. And this is one of the impetuses for growth in India as I see going forward. So leadership is very critical. And of course, the rule of law, very, very important. And having, I hate to use George Soros's words, but an open society is very, very critical, I believe, because an open society results in creativity and innovation. And that's what's really driving the growth of India and other countries around the world.
Mark, let's shift focus and understand your portfolio positioning right now. After spending decades at Templeton, you started off with Mobius Capital. Talk to us, how's the composition of Mobius Capital looking like right now? Overall, what kind of basket are you running? How much of it is in India? How much on which geography?
Well, the two largest holdings in terms of country, India and Taiwan. Taiwan, mainly because of the semiconductor revolution, and we're looking at companies that do the software for semiconductors. So that's one very important area for us, which we believe will continue to grow despite some people talking about a lot of semiconductors. But the reality is that semiconductors are going into an increasing number of things, including, most importantly, automobiles, which use a tremendous number of semiconductors. So that's one area. The other area in India is in healthcare, in basic infrastructure companies doing tubes, for example. Apollo Tubes would be one example of a company, and software. So in India, the portfolio is a little bit more varied, but we're betting more and more on India because of the reasons I've given earlier. We think that India is going from strength to strength.
So, even just a quick step back to, macros, you think India has a potential? I remember one of your comment the other day that India is a multi-year bull story, multi-decade bull story or something similar. You think even in this challenging growth environment, in the vicinity of 7% is something India can grow for next couple of years?
Yes, I do. I think India can continue to grow even in this environment because there's so much going on in the world today that besides the Ukraine war, besides the bear market in the US, and by the way, you must remember these bear markets don't last very long. They don't normally last more than 1 year and even less. And you must remember a bear market is measured from the top to the bottom, not from the top to the top, which a lot of people do. In other words, they say, oh, the bear market's lasted a long time because it took 5 years for it to reach the previous high. No, you go down to the bottom and the bull market starts at the bottom. And that's when you should start buying. And in the case of India, you have such a very vibrant economy, such important things happening. I believe the opportunities are great, despite what may be happening in terms of stock prices from one day to the next.
Wow, that's a very powerful point you made, that India is a vibrant economy. It's got decades of growth ahead of itself. So don't let the bear market dissuade you from buying bargains, because bear markets sometimes can be very swift to transform into early stage bull runs. Okay, so we were talking about your portfolio structuring. Healthcare is what you like. Automobile and software is what you're playing via the Taiwanese market. Apart from healthcare infrastructure, what else are you researching on closely here in India for the future bets? Because I know your research desk keeps on coming up with proposals to you.
One of the interesting areas of India, as you know, India has been a great exporter of software. You have Tata and you have other wonderful companies that are doing work around the world. I never forget, a few years ago, I was in Chile and I was visiting a department store and I saw cardboard boxes with Tata on them. I said, what's that doing here? They said, oh, they're doing all the software for our department store. This is in Chile. So India has been incredible in that way. Now, I believe India will become a big exporter of hardware, of technology hardware. So they'll begin to get the benefits of the desire of companies like Apple and others who want to diversify their base of manufacturing. They've been depending on China all this time, and they realize that it's quite dangerous to be focused on only one country in terms of their manufacturing base. So I think India will benefit from that going forward. So we're looking at that.
Lovely. So if I may just to get your understanding, your India the India portfolio which you are holding, do you see earnings visibility of 18-20% in your India portfolio despite of what's happening? Even if the numbers are worked downward, you see next 3-4 years of 18-20% growth or around that?
Well, if you look at this year, of course, the earnings will not be as robust as we might expect if you had a global situation which is very positive. But going forward, next year, the year after, you'll see very, very good growth. By the way growth is measured, of course, is year to year. And if you have a down year and a little increase the next year, it looks very, very positive because the percentage looks very, very big. But nevertheless, I believe that the earnings growth will still be there regardless of what's happening on the global stage. Again, emphasizing good companies that have low debt and high return on capital.
Mark, you've also been a fan of the Indian mid and small caps, the emerging companies. And that is a very difficult terrain to really navigate, because though it does have 3 good years after massive expansions, but the value destruction out there is also very big if business models are not robust. What do you have to say about that? Over there, do you see mid-cap, small-cap entered attractive zones or not yet here in India?
I think it's a very good point that you make about the mid and small cap. Yes, it looks like, if you look at our portfolio, it looks like we have at least mid cap, not necessarily small cap, because what we look at, of course, is liquidity. We've got to make sure that we can not only get into a stock, but get out. So we look at stocks that are doing at least $1 million turnover daily, on a daily basis. That's number one. The number 2 point is that what is a small cap? What is a big cap? In India, maybe billions of dollars, maybe much, much bigger than a small cap, let's say, in Vietnam. So around the world, the definition of small and mid cap is quite difficult to put your finger on. So what I try to tell people is that forget about the mid and small cap. Let's go after companies that no one else is looking at. And usually those companies are the companies that are not in the index. So we try to avoid companies that are part of an index, because those companies are probably very, very well covered, very well researched. And it's our job to find companies that are not very well researched so that we can have a little bit of an edge in terms of knowledge about what's going on with the company, and hopefully maybe surprise the market as a result of finding something that looks interesting.
Right. All right, Mark, we'll let you go on that one. Thanks so much for joining us today. And I would like to reiterate from my entire team here at ET Now how much we value your contribution and our association for almost 1.5 decades that ET Now is celebrating its 13th anniversary. Thanks very much and have a great day ahead.
Thank you very
and
much.
Guys, with that, it's a wrap on this show, on this edition of the Newsroom. Hope you enjoyed this very valuable and full of wisdom chat with Mark Mobius. Thanks very much. Goodbye.